Your portfolio can be performing well and still quietly working against your tax strategy. A lot of business owners and high earners are paying unnecessary taxes inside their investment portfolio, and they don't even realize it because most portfolios are built to maximize returns, not maximize what you actually keep after taxes. And for high income business owners, that difference can become very expensive over time. I see a lot of portfolios that look great on paper. Good returns, diversified, low cost, but they're quietly creating tax problems in the background. Most people don't even realize it until they look back and see they've been generating taxable gains every single year they didn't actually need. Because most portfolios are built in isolation. They're not built in coordination with your income, your business, or your tax situation. That's where things start to break down. I'm Matt Losanno with Cinder Wealth here in Georgia. I work with a lot of business owners and high income earners who have done a great job building income and building wealth. But their investment strategy and tax strategy often aren't actually connected. And that gap can become very expensive over time. So in the next few minutes, I want to walk you through three things, the three areas that really drive tax-aware investing for business owners: timing, location, and coordination. And more importantly, how small decisions in those areas can quietly compound into much bigger tax costs over time. So the first is timing. It's not just what you invest in, it's when gains are realized. Because every time a gain is realized in a taxable account, you're creating a taxable event. If that timing isn't intentional, you can end up paying taxes in years where you don't actually want or need the income. This becomes especially important for business owners because income is rarely perfectly consistent. Some years are much higher than others. Maybe the business had a great year. Maybe you sold an asset. Maybe there was a liquidity event. Maybe distributions were unusually high. If your portfolio is already generating large taxable gains at the same time, you can end up stacking taxes on top of peak earning years. And sometimes that happens simply because nobody stepped back and asked, do we even need to realize these gains right now? That's the part most portfolios ignore. It's not just about investment return. It's about controlling when taxes happen. The second is location. Not all accounts are the same. You've got taxable accounts, tax-deferred accounts, and tax-free accounts. Where you place an investment can be just as important as the investment itself. And this is where people accidentally sabotage their own planning. I'll give you a simple example. I have a client with a cash balance plan and significant assets overall. He knows his industry really well. So naturally, he wanted to invest in specific companies that he understands. The issue is, those investments were sitting inside the cash balance plan. And that's not where we typically want the highest growth assets because that account has lifetime limits. We're primarily using it for income tax deferral, not maximizing long-term growth inside the plan itself. Ideally, those higher growth assets would go somewhere like an IRA or even better, a Roth, where if that growth compounds successfully, we may never pay taxes on it again. Not all dollars are equal. And where you place the investment matters. And there's another piece to this that business owners don't always think about: liquidity and flexibility. A lot of high earners build portfolios that constantly generate taxable activity, even when they don't actually need the income. Short-term gains, distributions, unnecessary turnover. And over time, that can quietly create a tax drag that compounds against you. I've seen situations where someone's portfolio generated significant gains in a year where their business income was already unusually high. Now they're stacking investment taxes on top of peak earning years, when they were already in one of the highest tax brackets they'll probably ever be in. And sometimes that happens simply because nobody coordinated the portfolio with the broader tax picture. That's one of the biggest differences between tax-aware investing and traditional portfolio management. It's not just about maximizing returns, it's about creating flexibility, controlling when taxes happen, and coordinating investment decisions with the bigger financial picture. Third piece is coordination. Your investment strategy shouldn't exist on its own. It should reflect your income, your tax bracket, and what's happening in your business. I'll give you another example. I have a client who used to be in a very high tax bracket, around 43% here in Georgia. When we first started talking, their portfolio was built with about $3 million in municipal bonds to reduce taxes. And at that time, that made complete sense. But their situation changed. Now they're closer to a 22% tax bracket, and the portfolio was never adjusted. Now they're sitting in a strategy designed to minimize taxes, while potentially giving up returns they no longer need to sacrifice. The portfolio wasn't wrong, it just wasn't aligned anymore. And this is what tax-aware investing actually means. Not chasing complicated strategies, but making sure your investments, taxes, and financial life are working together instead of against each other. I've seen portfolios where someone is doing everything right, diversified, low cost, disciplined, but they're generating gains every single year in ways that don't match what they actually need. And over time, that creates drag. The goal isn't just to grow your money. The goal is to grow it efficiently and keep as much of it as possible. Because for high earners, taxes are often one of the largest expenses they'll ever have. And most people spend more time trying to improve returns by 1% than understanding how much they may be losing unnecessarily to taxes. If you're a business owner or a high income earner and you've never looked at your portfolio through a tax lens, it's worth doing. I run a tax and strategy assessment where we look at how your investments, your income, and your overall planning strategy fit together. And sometimes the biggest opportunities aren't changing the investments at all. They're changing where they sit, when gains happen, and how everything is coordinated. If you're curious how that applies to your situation, there's a link below, because at the end of the day, it's not about what you earn, it's about what you keep.